So I want to talk about my trades for week ending September 4th. Had a gross profit of $652. So let me go through the trades. So first thing off the bat, you can see that I've had way more trades. In fact, I had about 16 trades. So if you saw my video where I show a list of trades that a subscriber sent to me, I was inspired by the trades really. So I decided to be more aggressive this week and just do more trades, do more put spreads on high IV stocks. So I kept my SPY put spreads that I do every Monday, Wednesday, Friday. That didn't change. So the one that I had opened Friday, August 28th, I closed it last week. Opened for 62 cents, closed it for 31 cents. I did 2 contracts. So that gives me a $62 gross profit. And then I did a put spread on DocuSign before earnings. I think I opened it on Monday, or actually I opened it on Friday. Apple and Docu, I opened it on Friday, August 28th, because it had high IV. And I was actually able to close it for 30 cents on Monday, and Apple I was able to close it for 32 cents. So I was able to close DocuSign before even earnings was announced. So that's a 65-cent profit. Sadly, I only did 1 contract. Wish I did more than 1 contract. Wish I did 2 contracts. Actually, I'm going to start doing 2 contracts just to be consistent and give every trade the same amount of risk. Apple, I did 1 contract as well. So opened for 90 cents on Friday, closed it for 32 cents on Monday. And glad I did, because this would have been a losing trade if I kept it till Friday. As you saw, Thursday and Friday the market just tanked. On Monday, August 31st, I opened a SPY put spread at 344 short strike for 59 cents, closed it for 27 cents the same week, giving me a 32-cent profit. I did 2 contracts, so that's $64 gross profit. Now Zoom was an earnings trade that I opened on Monday at a 270 strike. So I did a put spread. So as you can see, they're mostly put spreads. I did a put spread at 270, 265. I collected $1. So my max risk is $4, and my max risk occurs if Zoom falls below 265. Instead, Zoom decided to go to 450, 460. So that was completely a winning trade. So I didn't buy it back to close it. I let it expire worthless on Friday. Although Zoom, as everything else, tanked, and I think it was trading at around 350. So still pretty far from my short strike of 270. So I let it expire worthless, so I get to keep the full premium, and gross profit of $100, and I paid less commission for that trade. So that was a really good trade. I liked it. CRM is another put spread that I opened. It didn't have earnings, but it had high IV. I did a 257.5 short strike, another put spread. And I think I closed it the next day for 35 cents. So I collected 80 cents, closed it for 35 cents, giving me a 45-cent profit. Lululemon, I think I opened and closed the same day, collected 80 cents. It was a put spread, closed for 40 cents. Baba, same thing too, another put spread. So as you can see, I just did more put spreads last week on stocks with high IV. That's basically it. And I closed them for whenever I had a decent profit. I closed it, and definitely glad that I did, because otherwise they would have been all losers last week. So what really saved me is taking profits early and earning trades like ZM. I played FedEx, just a high IV stock, 215 short strike. I collected 80 cents, closed it for 36 cents. Nvidia, another high IV stock, so 500 put spread, collected 95 cents, closed it for 44 cents. Now Tesla was a high IV stock as well, of course. I opened a 430, 425 put spread, collected 85 cents. This was a losing trade because Tesla dropped below 430, actually went all the way down to 360 by Friday. Now I tried to mitigate loss, so my max loss off the bat is $5 minus the 85 cents that I collected from the put spread. So it's about $4.50. When Tesla drops below my short strike, what I like to do is sell a call spread on the other side to collect more credit and reduce max loss. But because I got emotional, or I had hope that it would recover, I didn't take action quick enough. I didn't sell that call spread quick enough. I ended up selling it Thursday, almost at the end of the day, and I collected only 61 cents. But if I had sold a call spread as soon as Tesla dropped below 425, I could have collected at least $2. So instead, I collected 61 cents. So now my trade on Tesla, 430, 425, and then a 430, 435 call spread, I only collected $1.46 from it. And if you saw my video on me trying to close Tesla for less than maximum loss, I was able to close the whole spread for $4 instead of closing it for $5. So my loss is about 247 from the put spread, and I actually lost money from the call spread. For some reason, the call spread, I closed it for more than 61 cents. I closed it for 68 cents. So that's kind of weird. So basically that call spread that I opened ended up losing me money. I should not have opened it. Kind of weird. Anyways, it was just a $7 loss. CrowdStrike was another earnings trade. I did a put spread, 115, 110, open at 80 cents. So CrowdStrike actually dropped after earnings, but because there was a volatility crush in the premiums, I was able to close it right away at the open for 15 cents. Actually, I think it was 14 cents. I don't know, 14 cents was DocuSign. So I closed it for 15 cents and I had opened it for 80 cents. So I opened it. So this was an overnight trade. So a 65-cent profit. I did one contract, sadly. So imagine if I did two contracts on all these instead of one contract. And I'm going to go, and after I go through my trades, I'm going to see what would have happened if I did two contracts, just to be consistent instead of one contract. And then obviously when Tesla dropped below my existing put spread, I sold another put spread at 380, 375, assuming that, okay, if it dropped from 500 to 430 and then it dropped even more after that, I'm assuming 380 becomes an even safer trade. Collected 84 cents, also for the same expiry. Now, pre-market, I saw Tesla trading at around 380, so that scared me, of course. I was afraid that I'm going to lose on this put spread and I'm going to lose again on this put spread. Pre-market Friday, it was trading in the 380s, but it opened around 400 and went all the way up to 428 actually in the first few minutes of Friday trading. So I closed it quickly. I didn't mess around with it. I closed it for 40 cents, so more than 50% profit. And it actually dropped all the way down to 360 on Friday, so I'm glad I closed it early. Now, if I had held on to it till close, it would have expired worthless. I would have kept all 84 cents. But obviously, I don't know that it was going to expire worthless. I mean, I saw Tesla reach 360, so I had to take action. I had to close it. And if I don't take profits, a bunch of these trades would have been losers. So this one ended up being a profit of 44 cents or $44 gross profit. I also played DocuSign again. So I played it earlier, Friday, August 28th, before earnings, and closed it before earnings. But then I decided to play it right before earnings the same day. So Thursday before close, and I closed it Friday at the open. So I went with a 200 strike, collected 81 cents. I did one contract again, and I was able to close it for 14 cents. Even if DocuSign dropped after Friday open, it dropped a little bit. So still able to close 14 cents, giving me a $67 gross profit. At the same time for DocuSign, I actually played the naked call at a 400 strike. So DocuSign was trading at around 230, 240 Thursday. So I decided to sell a naked call at 400. So it's very far. I mean, what are the odds that DocuSign goes from 240 to 400 after earnings is released? I mean, Zoom did it, but what are the odds that DocuSign does it as well? So I sold a 400 strike naked call, collected $1.50, and I let it expire worthless because obviously DocuSign opened at around 220 on Friday, so for sure it wasn't going to reach 400. So that expired worthless. So that's a $150 gross profit. So that's why my total gross profit for the week is $652, which includes the loss on Tesla of $247, which could have been worse. Now, I do have a trade that's probably going to cost me a lot of money. The SPY put spread that I opened on Wednesday, September 2nd, I opened it at a 348 short strike. I collected 60 cents. Now, that same day, SPY went from 356 to 359 almost. I had a chance to close this spread for 32 cents, but because it wasn't a perfect 50%, I didn't close it. And the next day, Thursday and Friday happened, and the SPY just went below my strike of 348. It even went below, it even reached 335. So when it reached 335, I had to take action because SPY had dropped below my short strike and also my long strike on the put spread. So I took action a bit, once again, same thing as Tesla. I took action a little bit too late. I sold a call spread for only 59 cents. So now I've got an iron butterfly. So these two trades are actually combined. It's an iron butterfly right now. And I only collected $1.19. And I've got two contracts. So that means my maximum loss on this trade is about $880. And that'll happen if SPY is trading below 343 or above 353 come expiry of September 9th. For me to win on this trade, it really needs to trade between 347 and 349. That's my break-even zone, between 347 and 349 by September 9th. So I really shot myself in the foot on that one because I basically have a very small chance of winning. I collected very little credit, and I could potentially lose $800 on this trade, which would wipe out a lot of my profits, unless I make a lot of trades next week that will compensate for it. Now on Friday, of course, when SPY dropped all the way down to 335, but I actually opened the trade at open when SPY was at 346. So when SPY was at 346, I sold a put spread at 335. 330, collected 60 cents, and I did 2 contracts. Now, I don't think I'm going to be doing SPY put spreads right now. I think I'm going to be focusing more on stocks with high IV, because as you can see, I'm only collecting 60 cents. But I'd rather focus on stocks that were paying me with the put spread at the same probability of in the money, which is about 20%. I'm collecting 80, 90 cents, sometimes $1 as well. So I'd rather play these put spreads with better premium than to play the SPY, which only pays me 60 cents right now, because IV, implied volatility on the SPY, isn't as high as these individual stocks. And then when I come to mitigate a SPY put spread, I'm not collecting enough from the call spread. So potentially I could lose more on a SPY put spread, even if I started off with the SPY, because it's supposed to not move as much. But it's all relative. I mean, because it doesn't have high IV, my short strike isn't that far from the current market price. But when I do a put spread on a stock with high IV, the short strike is much further. I mean, Tesla was, I think, 30 or 40 points away. Zoom was about 40 points away as well. DocuSign was, I think, 30 points away, while the SPY was only 6 or 7 points away. So I think I'm going to focus more on high IV stocks for next week as opposed to the SPY, unless SPY becomes a stock with a high IV, and that'll happen if VIX goes up and everything's tanking. I'll also focus on earning trades because they're overnight trades. They're not dependent on the general market. They're really just dependent on market reaction of earnings announcement. So I'm in and out. So I open the trade before earnings and I close it right after earnings. And these are my commissions approximately, and it's about $188. So that really is annoying. Out of $652, I have to pay $180 of commission. So I'm left with less than $500 net profit for the week. But it's US dollars, so that's good. So it's almost $700 Canadian. Now, like I said, I'm at 652 gross. Now let's see what happens if I did 2 contracts on everything instead of just 1 contract. Moving forward, I think I'll be doing 2 contracts just to be more consistent and to pay less commissions per trade, and also just to use more of my capital. I mean, I'm not using a lot. I'm using very little of my capital in these trades. So I'm not taking advantage of winning trades that much. So if I put 2 everywhere instead of 1, so obviously if I put 2 contracts even on the losing trades, I lose more as well. But I also make more from the winning trade. So overall, my gross profit for the week would have been $11.78 US. That's my gross profit. Commissions would have been, so the $5 flat fee doesn't change. What changes is the 75 cents per contract. I just added 2 contracts times 16. So 32 times 75 cents is what I would add extra. So I would have a gross profit of about $11.78 and commissions of about $188 plus $24. So let's say $210. So obviously much better, much more efficient if I had just done 2 contracts last week on everything. So big difference. Now just for fun, let's see if I had done 3 contracts. I don't think I'm gonna do 3 contracts, but I'm just curious to see what would have happened. So if I had done 3 contracts on everything, would have been $17.67 gross profit last week. The reason why I wouldn't do 3 contracts, because as you saw Thursday and Friday, all these put spread would have been losers on Thursday and Friday. So imagine if I did 3 contracts on all these, it would really hurt my account for that week. So I want to give room for a bad week where my account will get hurt. So the impact of 2 contracts is better than 3 contracts, is more tolerable. But of course, I'm not going to do just 1 contract because it's the profit of 1 contract is not enough. And commissions eat up too much of the profits when I just do 1 contract. All right, so let's go back and put the real numbers, sadly. Hopefully next week isn't as crazy as Thursday and Friday. All right, so I just want to share my trades with you for last week. If you have any questions, any comments, any suggestions, any opinion or feedback about the trades, leave them in the comments section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free trades. If you enjoyed this video, click the like button, share it with a friend, and subscribe to the channel. Thanks for watching.